the globe. We have Mr. Manishi Raychaudhuri joining us on the show right now. Very good afternoon to you, Manishi. And it has been an eventful week of sorts because you had so many events to watch out for, be it the US elections, be it the FOMC rate decision. Also, you had back home, you had Diwali and you had to look at the Diwali sales, the auto sales numbers. Tell me, how are you reading all of these various signs that you're getting in for the markets? Firstly, let's talk about the US elections.
Absolutely. That's possibly the most important development that the whole world had been waiting for, including financial asset investors, both equity and fixed income. And the apprehension originally was that we would get a long drawn out result environment in the sense that it'll be a very close call. And the final results would not be quite available for a few days. But that hasn't come to a pass. And we have, uh, a landslide victory for the Republicans, which is obviously a good outcome for US equities because that, almost certainly leads to corporate tax cuts. It also leads to lower regulations in certain sectors, like banks, for example. But at the same time, it's not so good news for fixed income because it means that the fiscal deficit in the United States is going to rise. It would also mean, as a consequence of the anti-immigration policies and deporting thousands of illegal immigrants, labor costs will possibly rise up going forward, and as a consequence, we will likely have higher inflation, which could in turn lead the Fed, the FOMC, to have a slightly slower pace of cutting interest rates than was anticipated earlier. So, what does this mean? I mean, when we all put this together, it's good for US equities, bad for US fixed income. And at the same time, it may not be such good news for emerging market equities because it also means that the US dollar would stay stronger than anyone had anticipated. We have already seen that. And likely this environment will continue for longer, which means that money will continue to flow out of emerging markets. So it's kind of a mixed bag, and investors will have to navigate carefully across the financial asset spectrum.
Okay, a mixed bag, but Manisha, just wanted to get a better sense from you regarding India itself after the correction that we have seen in the month and a half. Is it now approaching a reasonable zone at all? Any pockets that are looking interesting?
Now, India's correction, in a sense, it had to happen. If I go back to the late September, early October period, India was trading at almost 90% premium in price to earning terms compared to the Asia ex Japan average. What has happened is India has corrected somewhere in the range of 8 to 9%. And other Asian markets, particularly Greater China and Hong Kong, has moved up sharply by about 20 to 22%. And as a consequence, the relative premium that India used to enjoy has declined. It's a very healthy correction, very healthy development, I would say. From 90% premium, it has now come down to somewhere around 55 to 60%. But at the same time, Indian earnings estimates are also coming down. If you look at the consensus EPS estimates for 2025, 2026, over the last 1 month, maybe 5 to 6 weeks, they're down about 5%, which is a major departure from the trend that we had seen earlier. So I would think that the Indian correction that we are seeing and this whole valuation realignment game, it's not yet over. It will continue for some more time. Once India's valuation premium comes down to maybe around 35 to 40%, and mind you, the last 15-year average is about 25%. So, yeah, once the premium comes down to somewhere close to those levels, I think investors would definitely take a closer look at India. There are sectors and stocks that have corrected much more than the market. The market itself is a consistent compounder with return on equity higher than cost of equity for many years. So a good quality market can't really be ignored by domestic or foreign investors. It was the valuation that was the concern. which, in my opinion, is correcting and will likely correct for some more time. And that's a very healthy development.
Right, healthy development given the fact that the valuations are correcting or maybe also likely to correct a further bit more. So you've said that there are pockets where you can look at. Which are those pockets, Manishi, that you are looking at very closely when you talk about the Indian markets, and where should one actually go and look for opportunities?
I've always been and I remain over the long term very positive on the private sector banking universe. India, if it continues to grow at about, say, 7 to 7.5% over the long term, that growth will have to come from investments and consumption. And it's the private sector banks which would be financing, that growth. They're also gaining market share over the public sector banks. Obviously, in the near term, maybe over the next 1 or 2 years, we would see the net interest margins coming down. They're already beginning to happen. But it's not something that would worry me over the long term. I would also look at engineering, advanced manufacturing. I would look at some of those EMS companies, the electronic manufacturing, and maybe defense stocks now that they have corrected quite a bit. Many of these are also beneficiaries of what we call China plus one. And given the Trump administration's focus on increasing tariffs, particularly on China, I think that's a particular initiative, the realignment of the supply chain that would possibly gain momentum going forward.
Okay, so financials in some of these engineering, capital goods, defense companies look good. Our last question before we let you go, Manishi, and that's on consumption. It's a bit of a mixed bag right now. Are you looking at it as half glass full, that there would be a recovery and it's available at a bit of a cheaper rate right now, or you're in the camp that one should stay away from it because there's problem?
I think over the next 2 to 3 quarters, we do have an issue with consumption, particularly urban consumption. In this current result season, we have seen the large frontline companies talk about urban consumption moderating. And that's clearly related to, the kind of employment opportunity generation that we're seeing in India. Remember that many of these companies, they're not cheap. Even after the recent correction, many of them are trading anywhere between, say, 40 to 50 times price earnings multiples, sometimes even higher. So I would definitely, in the near term, be cautious about that universe. I would be very selective. Over the longer term, yes, I mean, particularly I would focus on consumer discretionaries, not so much on consumer staples, because as the population gets affluent, more and more of, a larger share of the income would be dedicated towards discretionary consumption and away from, the routine staples consumption.
All right, then we leave it there. Thank you so much, Manishi, for joining us on the show to give us a quick take on the markets, the events that have played out, as well as which are the safer pockets that one can look at in this volatile conditions. Thank you so much, Manishi. Once